Hello, my name is Thomas Green, and this is my entrepreneurial toolbox assignment, um, and it is on employee-related tax documents and instruction booklets. First up, we have our Employee Identification Number, or EIN. An EIN is a unique 9-digit identification number that is assigned to a business entity so that it can be easily identified by IRS. Essentially, the EIN acts as a social security number for a business. It identifies who is required to file various tax returns. Applying for an EIN is free. It just requires you to fill out an application on the IRS website. Next up, we have our Employee Withholding Certificate. Our W-4 establishes the amount that an employee wishes the employer to withhold from their check in order to pay their federal income tax. A withholding is defined as the portion of the employee's wages that is not included in his or her paycheck but is instead remitted directly to the federal, state, or local authorities. The amount withheld is based on the amount of claimed allowances that the employee wishes to make. An allowance is defined as an exemption that reduces how much income tax will be withheld from a paycheck. Some examples of allowances: an employee may claim an allowance for him or herself, one for a spouse, and one for each child or other dependent in the house. Other allowances include head of household, child care expenditures, and claiming child tax credits. Your goal as a taxpayer is to determine how many allowances to request in order to accurately pay income tax for the year. If you get a huge bill in April, it means that you filed for too many allowances and didn't withhold enough money to cover your taxes. If you got a huge tax return, it means you didn't file enough for allowances and essentially gave the federal government a free loan over the course of the year. If no W-4 is submitted, the employer assumes that the employee does not want to claim any allowances and thus wants the maximum income withheld. Next up, we have our W-2s. W-2s are used to disclose personal taxable income for the year. They are also used by companies to report taxable income for their workers. As an employer, you are legally required to provide copies of an employee's W-2 to the employee, the IRS, and the Social Security Administration. If a company files with W-2 tax forms, then taxes will be withheld for federal and state obligations. These include Social Security, Medicare, and Medicaid. The Statement of Income, or 1099s, are used to report various sources of income. This differs from W-2s in that taxes are usually withheld by the payer. Taxes are paid quarterly based on estimated annual tax liability rather than every pay period, and 1099s do not show tax paid, only tax from each client. Some example of 1099 include 1099 div. This is filed if you own stock or other securities and have received more than $10 in distributions, such as dividends and capital gains distributions. 1099 mis, which must be filed by any client that pays an independent contractor more than $600 for professional services. A 1099-K must be filed if you have a business and have at least 200 transactions and at least 20,000 in sales during the year that are processed by a third-party payment processor such as PayPal. 1099-G is used to report unemployment compensation, state and local tax refunds, and tax grants. And 1099-R are filed when you receive a distribution from a retirement plan, for example, a 401k. A payroll payment voucher, IRS 940, is a federal unemployment annual tax form. It is used to report and pay unemployed taxes to the IRS. Unemployed tax are paid by employers to fund federal and state unemployment tax funds. They provide payments to employees who have been terminated or laid off from their employer. IRS Form 940 must be filled out if businesses have paid $1,500 or more to employees in a calendar quarter of the year, or businesses had one or more employees for at least some part of the day in any 20 or more weeks in either of the past 2 years. These include full-time, part-time, and temporary employees, but do not include partners. Employers' quarterly tax returns, or IRS 941, is used to report income tax, Social Security tax, or Medicare tax withheld from employees' paychecks. It's also used to pay the employer's portion of Social Security or Medicare tax. Form 941 is required from any person or business that pays wages to an employee. The employers must report the number of employees, the total wages paid, and the amount of taxes withheld from an employee's paycheck. The annual return of withheld federal income, or Form 945, is used to report withheld federal income taxes for non-payroll employees. This includes the holdings of pensions, gambling winning and Indian gaming profits, interest and dividend payments, payments subject to backup withholding, such as those to independent contractors, and some government payments. There are several consequences for not filing on time or filing at all. The first of these consequences is late penalties. A late penalty would be any filing later than the date of April 15th. You will typically get hit with a charge of 5% of the unpaid taxes you owe every month. This normally caps out at 25%. A smaller penalty of about 1% is owed by those who file on time but don't pay owed taxes. Next, lost returns. You have 3 years to file to claim backed up owed tax returns. After that, the IRS will treat your returns as a cash donation and you lose the right to them. 3. Substitute of returns. If you fail to file your taxes for several years, the IRS has the authority under U.S. Code Section 6020 to file substitute returns using W-2s, 1099s, and any other information they have to calculate what you owe. Finally, legal action. After sending multiple notices to your residence, the IRS may send somebody to collect payments. This usually only happens after you owe over $25,000 in returns. Continued avoidance can lead to wage garnishes, seizures of assets, and even jail time. A wage garnishment is defined as when a court issues an order requiring your employer to withhold a certain amount of your paycheck to send directly to the person or institution to whom you owe the money until your debt is paid off. An asset seizure, or tax levy, is the legal seizure of taxpayers' assets to satisfy back taxes owed. And here are my references.